first one was so much fun. We decided to have a second one, and I've got Dr. K here. I think we heard him right now. Dr. K, you there?
Hey, all good here in London at a bright 3 a.m. in the morning.
Okay, very good. Just to make sure that everybody can hear us, could I have some of you send in a question just affirming that you can hear us fine? You're on. I hear you. I hear you. Okay, very good. That's good. Thank you. Thank you. Okay. All right, we also have Bill Griffith. He's Director of Operations for Mocha Investors. Bill will be recording this so that we can put it up on the website later on for everybody who's asleep. So I just want to point out that we did have some Europeans who were not happy with the fact that we were doing this at 3 a.m. London time, but Dr. K is up, right, Dr. K, and you're wide awake?
Well, I am a bit of a night owl, so it's a bit of an unfair advantage because my sleep schedule tends to be resemble that of a vampire, so I don't want to compare myself to other people.
Okay. Yeah, we're actually all on New York time when it comes right down to it. We're all on market time, U.S. market time. Anyways, we want to talk about today over the next hour, less than that actually, because I know, well, many of you were concerned about missing the Jets-Steelers game. I'm actually more concerned about missing the Simpsons, which is at 8 o'clock Pacific time. So we'll be done by 8 for sure. But in any case, we want to go over the market and what's going on with leading stocks. Things changed somewhat drastically after Tuesday. You know, on Tuesday, things were looking pretty good. You can see here the NASDAQ pushing to a new high. Volume was picking up. Looked pretty good. Things look very nice. And the thing about a market top is it usually happens when you're not expecting it. Things will tend to look good as you're going into new high ground. And then all of a sudden, whack, you get some days where you start getting hit on very heavy volume off the peak, and you start to see some deleterious action in leading stocks, and we've actually seen that in a number of leading stocks. We saw F5 get clobbered. I believe that was Wednesday after the close. We saw Apple come out and gap up on what was a blowout earnings number in reverse. We saw Google do the same thing on Friday. So all of these things, you start to put them together, and you see the action in a number of stocks, even retailers like Deckers or Lululemon, Athletica also starting to come off. There are some things acting okay. We'll get to those later. But essentially, you can see the action of the indexes is looking negative here. But the one thing we would point out is that market tops don't occur in just a matter of a couple of days. If we go to April of this year, let's see, where are we? You can see where the market broke down. And you can see how you came down, you got hit with some volume here, not too much, and you sputtered around here, and then you started to really come off. The one thing we note about the end of April is that that's when QE1, or quantitative easing, where the Fed is going in and buying up treasuries and essentially putting money into the system, putting liquidity into the system. They stopped QE1 around this time, and you get a sense of what the market does when QE isn't there anymore. Now, as the market corrected going through the summertime into August, there was starting to be rumblings of QE2, and so the market bottomed by late August and early September. We had a follow-through, and we rallied up as the market anticipated QE2, which was in fact announced at the beginning of November. So we know that now that QE2 is in there, and it's supposed to be in there for how long, Dr. K?
Till June.
Till June. Okay, so here we are at the end of January now, and the market could be discounting some of this just as it discounted QE2 beginning in early November. It began discounting that in early September, so a couple of months before that started to happen. So it's possible we could fritter around here for a little bit, sputter back and forth, fake out some early shorts, what I call the piggy shorts, who try to come in too early because everybody wants to short the market right off the top, right? The bottom line is you don't have to. Tops will take some time. And right now, I don't see any short sale setups that look optimal to me. That doesn't mean that that won't come into play later on. It very well will if we go into a longer-term bear market. I notice we're just starting to max out in the number of attendees. So interesting that despite all the people who could not make it, we still get a number of attendees anyways. So we'll be able to, I think, to rotate a lot of these times. But anyway, so that's what you're seeing there. And so we start to ask ourselves, well, what's kind of going on underneath the hood here? And what's kind of interesting, by the way, we're using high growth stock investor charting software, which we use and we like it. It costs $599 a year. It's an aftermarket data download, so it doesn't give you real-time data, but you can hook it up in a way. We don't use it that way, but you can hook it up so that you get real-time data. And I think Ron and George and Ian over there do a great job with this software. So those of you who are interested, notice we're using these charts. You can go to their site, highgrowthstock.com, and check out their product. I think it's a good stuff, and it's a good value for what you pay. They let us use their charts. Other people won't. I won't name any names, but for some strange reason, we're not allowed to use certain other people's charts. We don't know why, but we'll let them figure that out, and we'll just go ahead and use something else since there are a lot of readily available programs out there. Now, one of the major divergences that we see here that is probably a warning sign. Would you agree, Dr. K?
I would, yeah, keep going. I'm with you so far.
Yeah. And that's the fact that the Dow Jones Industrials, you notice, as the market's getting whacked on Wednesday and Thursday of this past week, you're seeing the Dow stocks getting support, and then you see big volume, which is somewhat options related, on Friday as the Dow actually goes to a higher high. And the media seem to fixate on this, which to me sets up a contrarian situation in terms of people getting sort of starstruck with the Dow making new highs. But to some extent, it is showing you that you are seeing narrowing leadership. Now, I can look at the Dow index components. One of the things I like about this software is that it allows you to look at the components of the major market indexes, including the NASDAQ 100 and the Russell 2000. So you can actually look at all the stocks that are within these indices, and I think that's very helpful, especially when you have something going on where the Dow is leading. Interestingly enough, you have 3M. This is a pocket pivot, believe it or not. Correct, Dr. K? Is that right?
Yes, yeah, absolutely. It's a very clean one. It's a slow stock, but it's a clean pocket.
Yeah, so you have a slow stock, and we actually think, let's say the Dow were to lead for maybe a few days or a few weeks. That's possible. If you really want to play some such, maybe you could look at some of these. You know, we also saw GE gapped up on Friday. This is actually a viable gap up because it does exceed the average true range over the last 40 days. So this is a viable gap up. If you look at the overall pattern, you can see that GE, and by the way, it's interesting that President Obama named Jeff Immelt, GE CEO, as the head of his Jobs and Competitiveness Council, which is kind of interesting because GE needed $138 billion of buyout money or bailout money last year, and they laid off 18,000 people. So I'm not quite sure how that makes one an expert in jobs and competitiveness, but I don't know. Maybe these days you need to have an in with the government, and GE does. They're very much government supported in many ways. They were given $55 million, I think, recently for some off-the-wall projects, things like that. But you just go with the technical action here. This is moving up and gapping out. Would you play something like this? I suppose you could. Is it going to have a big move? You never know. But what's your take on this sort of thing, Dr. K?
Well, I think that extremely conservative investors might take a good look at this because it's a very constructive base. It's a gap up. It's a viable gap up. If it breaks the low of the gap up by say 1%, you're looking at maybe a 4% loss from buying the position here. So and you got some good upside because the base looks reasonably good. You got earnings that are coming back around. The earnings look pretty good. Sales are pretty anemic, but again, it does have what seems to be some sort of government sponsorship going on, and it is a Dow component, and there is a flight to safety we're seeing in Dow stocks and also utility stocks in the last few days. So it's a very low-risk play in this environment.
Right, but it seems to be arguing for a sort of a defensive maneuver as money pours into some of these bigger Dow stocks. You can go through these, and we see Hewlett-Packard has been trending up, so that actually helps the Dow index move higher. Home Depot, I go by Home Depot every day on the way to drop my kids off at school and pick them up, and there doesn't seem to be a lot of people in the parking lot, but I guess they're restructuring. Sales are very tepid, but you see they're able to turn their earnings around probably by restructuring, laying people off, and doing some other sorts of maneuvers that help to fluff up or pump up earnings. May not fluff up, but that's not what I meant to say, but to improve earnings and just cut costs. Meanwhile, Intel is a big tech leader looking kind of sick there. IBM is a big tech leader, but it's looking pretty good. Dr. K, do you view this as a viable gap up?
IBM?
Yes.
I would say it's a viable gap up given what it's done in the past. If you look at a weekly, it's really tight in there, and it's coming off a very tight, flat base platform. and the earnings
right here.
on the stock are very steady. They're very steady earnings that look like they're going to continue. So it is what I would judge, again, a fairly low-risk play, again, in this environment where things are looking to be higher and higher risk at the moment. So, if someone has to play a stock in this environment, if you said you have to play something, you're not going to get much bang from some of these names like GE,
like
but yeah, rather 3M. But IBM is, it's not a bad name in terms of getting some upside potential here. And the relative strength right now is 69, which could improve into the 70s. So it's certainly not as slow as a 3M stock.
Yeah, and there are some other big techs or big stocks that have been moving up. If we go through more of these, you can see AT&T is a dog. American Express is trying to hang in there. Go to a longer view here, give me a better idea what's going on here. Bank of America, it's a dog. Boeing trying to recover. Caterpillar was looking good last week, nice breakout here, but notice how the volume is picking up and it's breaking down. That's somewhat odd, and that to me that raises a red flag because this is the best Dow stock there is. It has an 88 relative strength. In IBD, the high growth stock is at an 87. But it tells you that this is the best RS stock in the group in the Dow Jones Industrial Averages, yet it's breaking down. And you see the ones with the lower RS ratings moving higher. Chevron has a 67 RS, for example, and it's moving higher. Although you'd have to say that doesn't look so bad. That looks pretty decent. Cisco Systems has been. Coca-Cola looks like it's breaking down. And that's pretty much what you've got going on in there. With Exxon, there's GE again. Hewlett-Packard coming up. I think we looked at these already. And that's pretty much the end of that. So we also notice when you see IBM acting okay, you also see Oracle seems to act okay. That's one of the few big cap names. And what's interesting about Oracle, and we'll kind of segue into where we're seeing group action going right now. The cloud stocks all got whacked along with F5. They all got knocked down. And that raised a lot of questions about the soundness of the group. And it may be, a lot of them have had big moves off the 2009 low, so maybe they need some time to base. I still think longer term, cloud computing is a major theme in technology and will continue to be. Both Dr. K and I were on the radio in a couple of appearances over the last week. And one of the things that we talked about is looking at the cloud theme in terms of stocks that maybe aren't so obvious, like Salesforce, F5, VMware. Those are pretty obvious plays. Riverbed, at this point, everybody knows about them, and they've been leading. So Oracle is the granddaddy of cloud computing. All of you may know that it was Oracle CEO Larry Ellison who initially postulated the network computer, the NC. And the idea in the 90s was that all of your applications would be held on the server of the internet, and you would access everything from there without having to load anything on your NC or your network computer. So it's basically like a dumb terminal concept. And it was really cloud computing, but way ahead of its time since we didn't have the bandwidth to deal with the sort of data transfer that you see in cloud computing. Of course, today that's a different story. And so Oracle is a big cap play, and what it looks like is money comes in here when it's running away from the other cloud stocks, and also you're getting some confirmation, from IBM acting well. Altera is another sort of a hardware play on cloud computing. It's broken down off of its breakout, but it's come right back on top of this little basing area. You had a couple of pocket pivot move, I think, in here. No, actually, no pocket pivots in here, but it's very tight. And then you broke out with Intel's earnings when Intel stated that they did well because of cloud computing related revenue. So of course that sparked Altera. But Intel really didn't follow through on its earnings. It's still kind of flopping around. I'm not sure. Somebody asked if they owned Altera in their portfolio, given that it hasn't busted apart, would you hold it? That would depend on where you bought it. I think if you bought it on the breakout, say between 37 and 38, you could try and hold it. It doesn't look like it's getting a lot of selling in here, but it may break down and test the 36.5 level, 36.50 level at the 50-day moving average, which is this blue moving average line we have here. Just like you saw CAT, for example, try to come out and then break down, and who knows what it's going to do at this point. But it is telling you that the market's kind of lost its mojo, its momentum in the short term. And so we're actually in cash. Dr. K, you in cash?
Yeah, 100% at the moment.
Yeah, and so am I. So we're just kind of hanging out. And, we don't worry too much about going to cash. If the market starts to wobble, especially after you've seen the index has come up so far from the early September lows, I think that you really can't complain too much. And a nice correction that lasts more than just couple of 3 weeks like we did here back in November. I think something that lasted longer, more like we had throughout the summer of 2010, would set up further highs. In fact, that's going to happen. I think you might need to see consolidation to set up further highs, but we don't know whether that will develop into something more severe than just, say, an intermediate correction of 7, 8 to 10%. We could go into something more severe. And so when we look around, we kind of ask ourselves, well, what are the themes that might develop that could present us with a bear market? And of course, we talked about what happens to the market when QE runs out. And of course, in April, we saw QE1 end, and of course, we got a correction, and the market started to discount QE2, which comes in at the beginning of November, and we go higher. And now we're coming into January, and QE2 is expected to end in June. So one of the things we've been looking at, whoops, I'm not going to find it that way. Let's go this way. Securities, put it up there, is this iShares S&P National AMT-free, I guess tax-free muni bond ETF. So this is tracking the national municipal bond market, and everybody's been probably reading about this over the weekend. California is in trouble. Illinois is a deadbeat state. All of these states are paying way too much in benefits to public employees, and they basically don't have the money to pay for all this stuff. Meanwhile, there's talk of letting the states declare bankruptcy, or the feds forcing the states to do something like declare bankruptcy, rather than opening up the taxpayer kitty so that the states can start dipping their hands into that money. Now, there has been federal stimulus money made available to the states in the short term, and that also ends in June. So what we think is interesting here is, muni bonds have always been considered a safe investment, right? People invest in muni bonds and they figure that nothing's ever going to happen. And it's always been sold that way. I started out as a broker in 1991 at Merrill Lynch, and you could get little old ladies, 92 years old, more than happy to buy a tax-free municipal bond paying 5 or 6%. You can get a lot higher rates now, thanks to the fact that they've been selling off pretty severely. And what bothers me about this, and Dr. K, does this bother you too? You can tell me after I'm done. But if you go back, when's the last time you saw the MUB really bust like that?
Well, it's 2008.
Bust like that. That's right. It was 2008, and here's where it happened. Now, we all remember this. The stock market blew apart right about the same time, and if you were short stocks, you made a lot of money during that period. It's a very short window here. But this blew apart. But notice how there's a lot of uncertainty embedded in this sort of action, because it's very volatile. It's swinging around. You see these wide ranges just back and forth in these crazy price ranges. And there was uncertainty about the mini market, because people knew that that could be a problem too, given the indebtedness of the states. I mean, people make a big deal out of Portugal, as a sovereign that's going to go bankrupt. But Portugal's economy is what, the size of Missouri's? And no offense to people in Missouri, but Missouri is really nothing. I mean, if California goes under, well, California is either maybe the probably lower now, 7th largest economy in the world. So that's a more serious problem. But what bothers me, and probably bothers Dr. K, and I'll let him answer in a minute here once I shut up, but this is volatile, and then you recover and you come back. And I remember these bids coming in, and this is when I sold every muni bond I was ever dumb enough to buy. So I don't own any muni bonds, and I wouldn't advise owning them or buying them, even if you think the rates are good. I think there's just too much uncertainty. You really don't know what the legislative outcome is going to be. But you notice that volatile break. Well, now this isn't such a volatile break. This is a pretty determined break, because you have stocks, long ranges, but yeah, this MUB here is breaking to the downside and closing in the lower part of the range. It tries to rally, and the rally's sold into, and the volume picks up again, and then the rallies again, and then it breaks down. Now you've got 1, 2, 3 waves down. Is this going to rally from here? I don't know. I see a lot of experts and people who might have a stake in muni bonds telling investors that this is a place to be getting into muni bonds. I don't know if I tend to agree with that. What's your take on that, Dr. K?
Well, the last couple of years has been a series of firsts that we've never seen before, just simply because since 2008 the market's been turned on its ear, and quantitative easing certainly is making things, it's gumming up the works, and it's rendering ineffective many indicators that had been working for a number of years, if not longer. So, you know, when someone says, oh, you know, look at munis, look how reasonable they are down here. This is the first. It's the best time to get it now, you know, because munis are almost guaranteed. You know, you got to proceed with caution in this environment. And just because an instrument has acted a certain way for many, many years, if not decades, doesn't mean it's going to continue to act that way in this environment.
And this seems to be telling us that this could become a problem. And of course, if we start seeing problems with the states, and they're going to have to make severe cuts. So let's just say they're not allowed to declare bankruptcy, but they're put in a position where they have to make severe cuts. And these are going to be pretty draconian. They have to be. Look at Jerry Brown, our old Governor Moonbeam from the 1970s. Looks like he's grown up a bit, I must say, and I'm happy to say that he seems to be taking a very realistic view towards what needs to be done. And he set forth or put out his budget on Friday, Thursday and Friday, and of course California legislators respond by shredding it and protesting. Well, that's going to solve a lot of problems, isn't it? And so I think if one way or another they're going to have to bite the bullet, and when that happens, you have to figure what sort of economic effect that could have when the states are cutting back, and most of the employment these days is coming from the government. What if that starts to diminish? Now you've got nobody producing any jobs, companies or governments. And so if this begins to get worse, this could be a reason for the markets to start to discount by topping and coming lower. So that's just something we're open to. You know, being in cash, we try to stick to Jesse Livermore's axiom, which is you don't want to be necessarily on the bull side or the bear side, but the right side. So it's kind of being in cash here, we can kind of think straight. We can always come back into stocks if you get pocket pivots. So to us, that's a very flexible tool to use that allows us to act flexibly and not worry about getting out of a position, locking in a profit, and letting it do its thing for a while, waiting for a pocket pivot to show up so that we can get back in, as opposed to having to wait for a new high breakout. So it gives us a tool that actually helps us limit risk by feeling comfortable about going to cash and getting out, because we know we can find spots to come back in and come back in early. Right, Dr. King?
Yeah, there was a question actually relating to that about you know, if someone's long certain stocks that had pocket pivots, but the model goes to a sell, and the follow the stock simulator also goes to a sell where they're selling out all its holdings. Do they continue to hold and wait until their 7% rule is triggered, or should they just bail out because the market looks like it's ready for a correction? And my answer there is that I think it's fine if you stay the course and hold your strongest positions as long as they have not violated your sell rules, because some of these stocks, some of the strongest stocks will buck the trend. But that said, there's nothing wrong with having or reducing or selling out your positions entirely, because know that you can always get back in on new pocket pivot buy points.
Right. So for example, or as an example, you can take Jazz Pharmaceuticals, which is a stock that's acting fine. And I would think you could probably hold this as long as it holds, say, the 20 level, and that kind of minimizes your risk to some extent. It's still about 7-8% below from here, but you could just sell it here and just wait and let it set up and form another pocket pivot and be buying it back. You know, you could have done that in certain points in here. It runs up, gaps up. This is viable gap up. Gets sideways in here. We went through a little market correction. If you were uncertain, you could have sold, I guess, and back in any of these points. But in here, you could back off and take profits if you're uncomfortable with the market, because I guarantee you, if the market comes in, it's probably retests the 50-day moving average down here. But if you have a low-cost basis, say you bought on this viable gap up, then you could theoretically sip through that if you want to. I don't like to. In most cases, Dr. K doesn't like to. But that all is going to depend on what the general market does. So what these stocks do is going to depend on what the general market does. Do we see any rotation here that might argue for money shifting out of certain names, such as clouds, the cloud computing stocks, and into somewhere else? Well, the Dow is really where it's at. So if you really want to play this market, you could, I guess, play Dow stocks like we talked about, like 3M, GE, IBM. So those look okay. Meanwhile, you see stocks like FCX, which was Freeport-McMoRan in the Stuff Stock Group. You know, this was acting very nicely, and now it has broken. Dr. K, is that a violation of the 50-day moving average?
Yeah, well, yeah, that I would call that a violation. Just it didn't close below the 50-day though. That's the thing. I mean, let me actually look at this
Did this
on
day
a
close below the
other
50-day? It looks
chart.
like it did.
Let's see here. I'll tell you in a second. Just I want to actually get a very good handle on exactly where the close was on my own chart here. So this is, yeah, it pretty much closes at the 50. It's close, and then it goes lower. So you could make the argument that it hasn't necessarily violated it. Given where it's closed, you could actually take the low of Friday's close as your violation of the 50-day. That's what I would do if you're still sitting on the position. So if it goes below
below that, you would sell it.
if it goes below 108, then and you still have it here, then blow it out. But you know it's at 108.4, so there's not a whole lot of risk in holding it to 108.
40 cents, yeah. But you are seeing some bad action here, and they did actually warn in their most recent earnings announcement. You know, there's some big numbers here going forward. 99.33%, 2 quarters out is what they're looking for. But they did warn, and that could be a problem. It's also declined.
Right. Actually, in terms of selling, I mean, the 10 and the 50-day moving averages are excellent guides. However, if a stock, say, were to gap down like this one did on negative news, an excellent tactic is often just sell it at the open. The news is bad, it's gapping down, just get out right at the opening bell, or even pre-market if you can, because a lot of these stocks, when they, you know, it rips their pattern, and you don't want to be sitting around in these and waiting for a 10 or 50-day violation.
Right. Dr. K, did you want to go through some questions? We had a few people email us questions, not very many, and Dr. K is going to go through these real quick, and then what we're going to do, since we're approaching halftime, we're going to look at some questions people are asking about various stocks, and so we're going to go through that. Dr. K, go ahead and answer the questions.
Okay, yeah, so, well, actually, we already answered one of them, but here's another one, just grouping them all together here. Okay, the question is, as a new investor, I would like to better understand the basics of how QE2 works, how it affects market direction, and how it skews the use of Canceling principles. Not sure. Okay, that's basically the essence of it. Just reading ahead here. Okay, well, QE is, as we all, most of us know, it's used by central banks to stimulate the economy by printing money, which it then uses to buy bonds, which increases the money supply, then which in turn increases the prices of bonds, and thus lowers their yield. So the effect of QE is that drops in the U.S. market since March of 2009 have been slight, and they've always been contained to a very mild 5 to 10% correction before moving higher. Now, the exception is May 2010. This is not surprising because QE1 ended April 2010. So, and QE2 didn't kick in until later in the year. So, consequently, we see rallies based on this QE2 that lack conviction, but nevertheless, the market continues higher. And we recently issued a buy signal without a follow-through day, which is the first of its kind, and this is due to the positive action we saw in leading stocks and the continued uptrend in the market. But keep in mind that even with this, as we know, the model's gone back to a neutral signal based on what's happened in the last week. So should the model switch from neutral to a sell signal in the coming days, and this could happen actually pretty quickly if certain things play out as we get more information. But keep in mind that this is not a normal market environment because of this QE2 that's going on and fights any downtrend. So, you know, O'Neill used to say, and still does, don't fight the Fed. So given what we've seen since March of 2009, odds are that if the model were to issue a sell signal, as it did on November 16, 2010, the market could soon find its low and then move higher from there. So you know it's a tricky environment. Now another question was, do railroad tracks have the same effect on a daily chart as a weekly chart? And he gives some examples. Okay,
what's one
answer? The odds are, well, some examples are CMG, November 30th and leading November 30th to December 1st. Those two lines look.
November 30th. Where?
November 30th. These are on daily charts.
Here?
November 30th and December 1st. CMG.
Oh,
yeah.
Oh, wait a minute.
Right over there at the top, yeah. I mean, my quick answer is that the odds are significantly greater that that railroad tracks will work on weeklies than on dailies. That's really all that needs to be said.
Yeah,
you get a lot of railroad tracks on dailies that don't mean anything. So I would use them for weeklies because you have more time in the pattern for the pattern to work when you're looking at it form on a weekly basis. Next question is, if I used options as a stock substitute, how should I calculate the 78% stop loss rule? Of movement of 7 to 8% in an option usually doesn't mean much. Okay, well, you should calculate. You should calculate it on the basis that 7 to 8% is your maximum permissible loss on your trade. Now, if volatility is far greater, such that you're going to get whipsawed out of your position, because it might be a futures or an options type of situation, then you have to increase your maximum risk tolerance level. Or, on the other hand, if it's beyond what you want, then you reduce your position size. So your net loss to your whole account does not exceed your maximum permissible loss based on this one trade. That's really the final important take-home message is never put on a trade where your potential risk is going to exceed your maximum, what you're willing to lose in the account on that one trade.
So what you're saying then is if you're going to pair a stop loss in an option, you're going to use the 7 to 8% drop in the stock as your signal for your stop in the same option. Depending on the option, you get your head handed to you in that particular options position. That's what you're saying.
Right. So in the option position, you should play smaller. In fact, Ed Seykota, the king of futures, always told me, you know, when he was, I remember showing me his portfolio at his home in Incline Village when he was living there, he would talk about how his position sizes were virtually never bigger than 5% and often much smaller than 5%.
That's why Ed's never invited me over to his house, I guess.
Why is that?
His 5% position. Gosh, that's for weenies. But anyways.
Yeah, but these, of course, are futures. So, you know, you can, on a 5% position that works out, you can actually, you know, remove your account 50%.
You're right. Right. So with options, you should keep your positions naturally closer to 5% or much smaller than you would with stocks.
Well, yeah, whatever the option is. I mean, you might be so in the money on an option that the risk is very low, but then you might be so out of the money on an option that your risk is very high. So you have to tailor it. Only you're going to know what your volatility is in that instrument, and you have to tailor your position sizing according to that volatility.
Yeah. By the way, if anybody has a question on a stock, you can just send in the ticker to us there's a little question box on the. I'm not sure what it is you guys see. I know what I see, but I have a little narrow box on one side of my screen on my other monitor that has room for questions. Do we have how many more of those, Dr. K, do you have?
We're about halfway through.
Get through them real quick. Let's get them done.
Yeah. Since we're still at around halftime here. So the question is, what I would like to know is what to do with our pocket pivot positions when market direction model goes to cash. Based on your portfolio management, I'm thinking we could at least scale back some, which I did, especially stocks that did not perform as well as others. Even with stops, after-hour drops can be significant. Maybe, so she says, maybe I should get out of all, but then do you lose out on that stock? Do you lose out on that stock that does not correct and continues to move up? And she makes
a long question.
With canceling stocks. Last year, she found that she would have done better if she had just held her positions. Okay, so essentially,
what was the question?
She wants to know how to deal with her stocks if the model issues a sell signal. And my answer is keep your stops in place. Don't ever violate your maximum risk tolerance levels. And there are many ways to size down if you feel you're overweighted in the market when a change in signal occurs. For example, if you're on margin, you could size down your position so you're off margin, or you could simply cut all your positions in half, or you could sell your weakness positions. So next question. This is part B. How does this affect the pocket pivot count? Do we need to see another pocket pivot to re-enter the previous pocket pivot position? Well, if the count always adheres to the rules regardless of the model signal, and if you sell a position that has not violated the standard sell rules that we talk about in the book, you could decide to get partially back into the position, though it would probably be better to wait for another pocket pivot in that stock. Let's see, we got four more questions. Is there a difference in behavior with foreign stocks compared to U.S. stocks in market direction model changes? And cites an example: if a particular economy is strong while our economy is weak, do you get a decoupling? Well, usually stock exchanges in other countries correlate with the U.S. market on at least a week-to-week basis. And for example, actually China, the FXI, which is the ETF that mirrors Chinese market, from 2005 to 2007 showed a huge degree of correlation with the U.S. market, but well outperformed the U.S. market over those years, as you can see. And it was not unusual to see leading Chinese stocks trading on the U.S. markets doing very well, outperforming. And note, when the U.S. market would suffer any kind of weakness, the Chinese market would also pull back. But when the weight of the U.S. market came off, the Chinese market would often soar. And keep in mind that these correlations are not on a day-to-day basis. Sometimes they're delayed by a couple of weeks, but invariably the Chinese market would roar ahead of the U.S. market over these years. Next question is: review again the sectors you will see as being outperforming in the near future, and ETFs are a sector. So, well, sorry, what's that?
Not really relevant. That's not really relevant. Review the sectors and the ETFs we think are going to do well in the future. How do you know that until you actually see it? So,
yeah, you kind of have to.
Kind of a meaningless question.
You go with the day-to-day action of what you're seeing as being potential. And of
right.
course,
we don't know what's going to be leading in the future, so we don't have a crystal ball. I pawned mine off for a new guitar, anyways.
Let's see. Next question is: during the first 7 weeks position in a pocket pivot stock, what other factors besides the risk tolerance level of 8% should we consider in setting stops on these new positions? From what I've read, it sounds like you give these stocks room to the 50-day moving average. And if they're like an IPO, does this change? Well, I would say try to give it to the 50-day moving average if it violates the 10 in less than the 10. If it violates the 10-day moving average in less than 7 weeks, try to give it to the 50-day, as long as it doesn't exceed your risk tolerance levels, your price point where you bought it. Now, IPOs are going to be more volatile in general, and they might not even be showing a 50-day moving average yet. So, due to that added volatility, you could just use the violation of the 10-day moving average as your sell stop. Final question: from the sounds of your emails, you sound like you think there might be serious issues with the cloud computing sector based on F5. I don't know how to understand these reports. Do they do poorly for reasons that will affect other cloud companies? Pretty simple answer. F5's negative report could affect the perception of the group as a whole. This brings up the point someone made last week about Equinix, ticker EQIX. It disappointed the market on October 6, 2010. And other cloud stocks immediately followed it lower. But after that short, sharp correction in cloud stocks, the group as a whole moved higher, outperforming the general market, which incidentally also moved higher. But I'd point out that EQIX was not a leading stock in the cloud space. F5, however, was a leader. So it comes down to really whether QE2 can overcome the damage done to leading stocks over the last couple of days. And in the end, we always said price volume action of the major indices and leading stocks will point the way forward.
Okay, I want to go over some of the questions we're getting in here. Somebody asked about Jazz. We already covered that. As we said, you could sell it if you wanted to with the idea of coming back into a pocket pivot. It could turn and go higher. So don't get mad at us if it does and you do sell it. Everybody always looking for a black and white answer to everything, but they don't exist, unfortunately. It acts well, so maybe it goes higher. Somebody else is asking us about AGQ. This is gold. Now, what's interesting about gold, since it broke out here, and the GLD looks similar. Well, let's go to the GLD because the AGQ is just, what is that, Dr. K? 2 times the GLD? Or 3 times?
DGQ is 2 times
And AGQ.
AGQ is 2 times silver.
Yeah.
Yeah.
Okay.
And then you want and DGP is the 2 times gold.
Okay. Now let's look at silver. The SLV, for those of you who don't watch Fox Business News, I actually was on Fox Business on September 23rd when it was somewhere around 2050, and I felt it was looking pretty good and was heading higher at that point, and it's gone over 30. Now, the interesting thing is, since it broke out, notice how the 20-day moving average has served as support for the SLV all the way up. So in my eyes, I look at this as a guide for selling it. So once you violate it, and notice here you don't close below the 20-day. That's the green line here. You don't close below it, but you do this day. Okay, so now if you move below the low of this day, that would be a violation. You got that here. Okay, now it's gapped down lower. So you could actually, once you saw this, you could either sold it here, or if you were lucky enough to be dumb enough and slow enough not to sell it here, you got a couple of days here to actually sell it a little bit higher. So sometimes better to be lucky than good. But in this case, once it violated this low and moved below that first close below the 20-day, in my view, that was pretty much it. And it tells you that silver and, of course, AGQ are likely to go in a correction here. Another thing to think about is that on the way up, silver has corrected, about 3 weeks here, 3 weeks here, 3 weeks here, and then headed off to new highs each time. Given this move, it probably needs more time, so I would look for silver to move higher. And also, this tells you that maybe QE is losing a little bit of its bite when you see that happen. Somebody asks us, how did we know to sell or go to cash? Well, for me, as I stated on radio, and I think Dr. K said this as well, when you saw the NASDAQ breaking hard off the peak on some pretty heavy volume, and you start to see some bad action in leading stocks, that's a sign for me at least to lighten up. And generally, if I see some of my stocks getting whacked, I'm gone, and I don't mess around. You can wait for things to come down further, as we said, and hit 50-day moving average or whatnot, and get out that way. But for me, I'm a little quicker, and when something doesn't smell right, I'm not really going to stick around and get hurt. Some of you have asked us, could we have anticipated the break in F5? And my answer to that is no. You can't anticipate it. But you will notice, for those of you who follow the stock portfolio simulator, we had 4 stocks in it, and I believe on Tuesday or Wednesday we cut Netflix, BMW, and F5 from 12.5% positions, 1/8 of our total portfolio, to 1/16 or 6.25%. And in the market, you're never going to avoid risk. So if you have some idea that there's some magic formula that's going to keep you from ever losing money or keep you from ever not knowing everything for certain, you should just give up the stock market, because that's not going to happen. You can't prevent risk. You can only manage it. So we look at F5. If we had been early, we bought in that portfolio, because I really started doing this concept in December. We're turning the follow the stock feature portion of the website into a portfolio simulator, which I think is much more valuable, or it's much more valuable to people to get an idea of how we would actually handle a real portfolio in real time, rather than just follow a bunch of stocks. We took our positions in F5 on these pocket pivots right in here. Okay, so going into earnings, what do we know? Well, number one, we don't have a big cushion in the position. So there's one thing that makes us cautious. Number two, you're actually seeing some volume pick up the day before, a couple days before earnings come in, and it's starting to drift down. So we think about it, okay, most of the time, and what is it, Dr. K, 7 times in a row F5 gapped up earnings or moved higher after earnings?
I believe it was at least 6 times in a row, if not more.
Yeah. Okay, so we knew that this
not
was
necessarily gapped up, but let's just say that the earnings were favorable, and it did have a series of gap ups. I think it did gap up
right,
possibly 3 or 4 times.
Right, and and I actually had calculated about a $200 and some price target on F5, so we thought, okay, it could beat earnings handily and gap up again. But what if it doesn't? Well, if we don't have very much cushion in our position to begin with, then why not cut it down to a position size where we're comfortable with a big gap down? So if you have a 12.5% position and it gaps down 20%, well, you've lost about 2.5% of your portfolio. If you have a 6.25% position, then if it gaps down 20%, you've lost 1.25 or 1.5% rather. So for us, that's pretty much a yawner. So that's how we handle that. But you're never going to know for sure. So whenever you're going into earnings, you have to think about two things. Number one, how much of a cushion do I have? Am I 20% up on the stock? Well, great. If you are, then it drops 20%. You're back to even. You haven't lost any money. On the other hand, you can ask yourself, well, if it's going to break 20%, how comfortable am I with that really, even if I do have a much lower cost basis? Well, then you figure, if I hold a 5% position and it drops 20%, I'm not going to lose very much money, 1% to my total portfolio. So you have to think of it in those terms rather than, how do you anticipate this? Well, you buy a crystal ball. But, I used to have one. I got rid of it because I tried to use it in 2009 and it screwed me up. So I pawned it off for a new guitar. Meanwhile, you have other stocks in the group are getting hit. Some people think this is a short. Maybe it is. Maybe it isn't. I don't know. I think it's too soon to tell, but it might continue lower. If you wanted to short this thing, you would probably use your 50-day moving average or at least the high of Friday or Thursday as a stop. But to me, I think that the shorting game is too early here because the market's just coming off the peak, and it takes time. Wait for the window of opportunity. Having made a lot of money shorting and taken big losses on the short side, and I should note that on the long side I hardly ever take big losses at all, in fact rarely, but on the short side is where I've really gotten killed, and it's often from coming in too early or staying too long, okay? So you come in too early and you'll get dinged around because the market may do what it did in April. You can see the first break, as when we went over those charts earlier, the first break off the peak did not result in a major breakdown, okay? Here's a NASDAQ, and here's your April top. You had these breaks, but it took a little while. So you get chopped up in here coming in short too early, and then if you come down here and you see the market here and now everybody wants to get short, then you might get chopped up being too late. So you really have to wait for the window to open. I don't see it opening yet. Somebody asked us about Microsoft. Microsoft's a dog. I would stay away from it. How do you feel about gap ups during market hours? How do you have a gap up during market hours? You mean, Dr. K, do you understand what that means?
No, I'm not sure. I mean, there's exceptionally rare cases where a stock gets halted because some news and then gaps up intraday. In other words, they halt trading, and then when it starts trading again, it gaps up on, obviously good news. And, that can be a viable gap up in that rare situation. If the news is good and the stock has gapped up in a contextually constructive way to its overall pattern, you can treat it like a gap up that occurred at the open.
Okay. Somebody asked us about Aruba Networks. Should that be sold? I don't know. Are you using any rules here, like breakdowns, gap downs through a prior breakout point? Or are you just waiting for someone to tell you what to do? I think if you bought the stock recently, you're underwater and you see it violating a pivot point here. Let's say this is your breakout point, 24.5. Is it more than 7 or 8% below that point? Those are things you need to be thinking about ahead of time. You shouldn't be asking someone, should I sell something now? As if now, I don't know, maybe it bounces up to 24 one time. I don't know. But if I was long this thing and I bought it at, say, 24.5, and you break down to 22.5, you're getting close to 7-8%, and I wouldn't mess around too much with it. So again,
I think I'd also point out, it did have a gap down on the F5 news, and that's bad. I mean, I would be out of this position at the open on Thursday. When it gapped down, and we already knew before the market opened how bad the F5 news was. So, and I point out actually when EQIX gapped down in October, I think it lost something like half its value overnight. A number of leading cloud stocks issued, they issued sell signals because they were all gapping down. Now, these same cloud stocks got back up on their feet, and they issued quality pocket pivots, which were viable and profitable just a number of weeks later. So, in other words, for something like Aruba Networks, I would have sold it, and then I'll ask questions later. I want to see if this stock is viable still. It's going to form a base of some sort. It might be a short one, and then it's going to issue a pocket pivot somewhere around the 50-day, or maybe it'll regain the 50-day on that pocket pivot, and it becomes viable again.
Okay, reading some other questions. People asking about, I'm not sure why this one comes up, but Weyerhaeuser? Weyerhaeuser looks okay. People ask, so, but this is what I think is an interesting question. What is your opinion of Weyerhaeuser? What opinion is there to have is what I want to know. The stock's going higher very sharply. Uh, Big earnings turnaround, and that's what it's doing. So you don't really need to have an opinion about things or what you think of it. That thing's in an uptrend, so that's all you need to know. There's really not much more than that. Somebody asked about MIPS. What's your take on this one, Dr. K?
Well, let's see here. Okay, I'm just looking at well, on a fundamental level, you know, you've got good fundamentals. It's a strong company, good industry group, composite rating of 99. But the problem is what's happened in the market recently. The technicals are still looking okay. I mean, it did have a very strong pocket pivot on the 13th of January, and then it's come off, but on lower volume than the volume on that pocket pivot day. And it's come off right down to the 50 days. So if you're sitting on this position, well, first of all, if you're not sitting on it, I would wait for this to issue another proper pocket pivot before doing anything. If you're sitting on a position, I would, given where it's at right now, I would wait for a 50-day violation to sell it because it's a strong stock and it might buck a general market weakness. So I would just sit tight and then settle it on a 50-day violation.
Okay. Let's take a look at, somebody asked about CLF. This is a lot like FCX, breaking down pretty hard. Looks like it's going to test the 50-day moving average. What do you think, Dr. K?
Looks like it's heading there pretty swiftly and steadily. That said, I made comment on this on CBS with Andy Gearsher. Actually, I was supposed to make comment on this. I think this one might have been truncated. This was the stock that is leading this sector. It looks like a very good stock. Relative strength 90, composite rating 97. It's a nice strong earnings and sales turnaround in the company. And because quantitative easing and the devaluation of the dollar is alive and well, this should bode well for commodities like this company. And so you know they're generating most of their revenues from the production of iron ore pellets, and their fundamentals and their technicals still look pretty healthy to me.
Yeah, but given this breakdown,
and if you're sitting in the position, you know, you could either use a 10-day violation that occurred on Friday as your sell signal because the market is weak. In other words, you can, when the model goes to a sell or a neutral signal and there's other warning signs, you can start, instead of using a 50-day as your sell signal, you can just switch to the 10 if you want to be a lot tighter with your stocks. But that said, keep in mind that leading stocks, as we've seen in many years, including the last 2 years, leading stocks will often get pulled down to the 50-day, then regain their composure, bounce off it, and start going higher again when the weight of the market comes off. And you know, this could be one of those stocks. So you know, it depends on your time horizon and your risk tolerance on what you want to do with this.
Yeah, for me, if you're looking to buy it, I'd just watch to see if it comes into the 50-day moving average. Let's look at ARM-H. ARM Holdings, that's holding the 10-day. So it really hasn't broken down yet, so it's acting okay. Keep an eye on that. Remember, and a lot of people ask us, you know, if the model, the market direction model goes to a sell or neutral, whatever, does that mean I sell my stocks? No, watch your stocks. And watch your stocks first, watch the indexes second, because even if the market goes into correction, certain leaders could go higher. But you want to keep an eye on them, and you sell your stocks on the basis of what your stocks are doing, not necessarily on what the indexes are doing, and just running for the hills, because sometimes stocks will continue higher after the market tops. So this looks okay for now, but it could change.
A market direction model is the emphasis there is to be able to make money off ETFs, which are relatively different animals from leading stocks, I'll say, because the majority of stocks are going to follow the direction of the general market, but leading stocks can every so often buck the trend, and some of these stocks can be actually held for a number of weeks, if not months, by utilizing the 50-day moving average as your sell guide.
Yeah, so looking at Priceline, for example, somebody asked about that. Priceline broke out through this base, very nice base. You had a pocket pivot here, so you could have gotten in early here. It held the 10-day on the pullback, broke out, went very tight. Now with the market breaking out, it pulls down, but notice It finds support and closes up off the 50-day with volume picking up here. Now it may, if it breaks down and you still own it, it breaks this breakout point at around 420 something. 420, you could probably use the 50-day moving average here. Then maybe you've got a bigger problem. And I would watch for this, because if that happened, then that might be a late-stage failed base. In which case, it might be looked at as a short, but that also takes time to develop. So, and that's something we'll talk about in future webinars. People asked about LVS. LVS had some pocket pivots. You notice in here and here coming up through the 50-day moving average, but we were using the 50-day moving average as a selling guide, and so it's violated that now, and it's either going to need to base further or it's going to break down. So right now we wouldn't be long that stock because it did violate the 50-day moving average. Cena is coming right back to this breakout point, so the question is it going to hold this 78 price area? Not really clear. So, but if you own it and you bought it on the breakout, you stick to your stop losses if it continues lower. Otherwise, you can't tell whether it's going to bounce here or not, because we don't have a crystal ball. Let's look at some of the others. People asked about CCME. I actually like this story. I think it looks pretty good here. On a weekly chart, it's a little less coherent looking. But you can go back and look at Cena and Sohu. And I think even NetEase back in the early 2000s when they first started going, I think back in 2003. And they had similar patterns like this, these weird little cups, and they looked funky at the time. I like the story here. They do advertising on buses, and it's about 25,000 buses in China right now. They're going to go to 35,000 in the next few years. That's what they say. And they're also starting to do online advertising. So nice story. The one thing with cheap Chinese stocks is sometimes the idea of there being something fraudulent is always inherent. So you'll see a lot of cheap Chinese stocks selling at 5 times estimates, and that may be telling you something. In this case, these guys have very strong earnings and sales. I know a number of hedge funds that have recently taken new positions in it, so it tells me that they've done their due diligence, and this is probably fundamentally sound. And so far what we can see here is you've made a cup, and you're trying to work on a handle here. Looks relatively positive. There were some pocket pivots down at the bottom, and you can see how pocket pivots can help you get in earlier on these more volatile, thinner Chinese stocks when they come up around. It doesn't always work, but it gives you a better reference point to be buying a pocket pivot, say here, as opposed to buying it up here or trying to buy it when everybody's getting excited about it. But I do like the way that it's held in. You notice how it pulls back. It runs up over 20, 21. Pulls back for a couple of days. You see the volume dry up in here. Volume picks up the next day. It runs up. Then you pull back again. Volume dries up some more. Now, what this seems to imply to me is that you're going to need to go sideways. So if we go into a correction, I keep an eye on this thing and see if it builds a cup with a handle. So here's your cup. You're only about 1 week. Well, you're exactly 1 week into a handle. So I want to see maybe 2-3 weeks, a little more time. That doesn't mean it's going to have to do that. It may actually just continue higher. Some people are asking us how we screen for stocks. For those of you who are new to this game, I'm going to give you a really good list to work from. All you have to do is use the IBD 50, or just look at stocks that have an 85 composite rating on IBD or higher. So that's what I stick to. If it doesn't have a composite rating above 85, then I'm really not that interested, although I do monitor stocks that will have a composite rating of 75 or higher, because that's how you pick up some of the emerging companies. But if you really want to work from a very good list, that's a small list, just use composite rating of 85 or higher and then work your way down from there. That's the best way to screen. It's the least complicated. You can use programs like this. HCS Investor has screening capability. Very simple stuff, but they also have these rankings that you can use that they provide that I've noticed really do just find all the good stocks. So I think this is a great product. I think using IBD and using the list they have there are good. Let's go through a few more of these. How's Amazon looking? Well, it's looking great. It's not looking so hot anymore. So breaking down, this is one of the things also that worries us about the market. So it's not holding the 50-day. That tends to be where it finds support. So if you're long the stock in here, you have to use a 7 to 8% stop loss first. And if it violates, Dr. K, would you say violation would definitely be a move below this low here on Friday?
Well, I'm just looking at it on, yeah, it closed at 177.42, and the 50-day is at 177.78. You can make the case it closed really at the 50-day. Um, in this market environment, if you're conservative, I would use a break below Friday's low as your sell, and if you're a little bit more forgiving, then I would wait for it to actually close more appreciably below the 50-day. In other words, by appreciably I mean maybe 0.4% or more, 0.3% or more below the 50-day.
Okay. I'm going to run through some real quick before we wrap it up here. It is 8 o'clock and the Simpsons are starting, so I really don't want to miss that. Google looks like a dog here. I think it would be shortable if this fails, but I wouldn't start shorting things right away, as I said. That's not looking good. Apple, all I have to say is I bought 2 iPads today, and I remember I bought a bunch of Crocs shoes right around October 2007, so I'm a great indicator. When I bite the bullet and buy something, that's probably the top in the stock. Apple doesn't look so good, but remember that it did break down after earnings in October and took some time to set up. Apple's selling at 17 times estimates. I don't know if that tells you it's cheap or that there's something wrong with their earnings stream going forward and the market perceives it. Because you would think if they're such a hot growing stock, they should be selling at 40, 45 times estimates. And so at 17, I don't know, maybe the market's starting to get a little bit filled up with Apple. In other words, institutions are up to their eyeballs in Apples, and that may be true. And then, of course, we can use me as an indicator. I just bought 2 iPads today, so that probably tells you everything you need to know. We have a lot more questions. Unfortunately, we're done for now. TIBX, somebody asked about moving straight sideways. IBD had a good story about it. I'd look into that, but given the way the market is, we're cautious about taking any longs. So this is actually the second of many more webinars to come. We're having a lot of fun with it. People seem to get a lot out of it, and we feel if we can help people out to whatever degree is possible, we're more than happy to do so. And we have a good time too as well. When we do these sorts of webinars, it does force us to kind of put our market views into a coherent view. I don't know how coherent this one was, but we'd appreciate your feedback. You can email us with questions at info@mochainvestors.com. And I would also point out that you can always go to virtueofselfishinvesting.com or selfishinvesting.com and check out our website. It looks like this. We have neat graphics. That took a lot of work. So if you just like to look at neat graphics, it's good enough. And we have all kinds of fun stuff on the first page, a blog and whatnot. So take a look. You have questions, send us emails at info, again, info@mochainvestors.com, and we'll be happy to answer them. And we look forward to the next webinar, and we'll see you all next time. All right? Take care. Bye-bye.
Take care, guys. Bye-bye.